Hi, my friends. So I just did a video forewarning you to be careful of insurance salesmen saying their insurance is paying between 4 to 6% on cash value. And going back almost 200 years, you've been able to receive a constant 4 to 6% dividend or cash interest or whatever, however they phrase it. Just be careful there. I'm telling you. So watch that video I just did. Now I'm going to share another video too with people. If people start saying, look, I have a safe product that's paying a whole lot more than certificates or a whole lot more than your bank, is safe and blah, blah, blah. I'm telling you, be careful. I remember in 2007, I had a bunch of people in the Hartford short duration, I think it's a bank rate fund that they had. And I liked the guy, the wholesaler. I was a fan of his. I thought he didn't do me wrong. He just told me what he knew was the evidence of this fund that had been 15 years in existence, never had a down year, short duration, short maturities, is liquid, and you know, it was just the lower grade credit quality because it's banknotes, and they're basically funding showrooms for the floor plans for vehicle dealerships and whatnot, which is always risky. Because in 15 years, it never had a down year. And I said, that sounds pretty good, man. Park some money in there, and then it got hammered. Bank notes, bank rate loans got killed in 2008. I think they were down. I mean, like hell, 45% or something like that. Is vicious. So he was right until he was wrong, as I was. I was right until I was wrong, and that's a scary thing. So anytime you hear people hawking something that sounds too good to be true, it probably is. So I want to look at the Vanguard Intermediate Term Corporate Bond ETF. The Vanguard Intermediate Term Corporate Bond ETF. It's right now, I think this is at the end of April, is yielding 3.32. All right. 3 points. Actually, let's look at just Vanguard. I'm looking at Yahoo. Let's just go to Vanguard real quick and see what Vanguard. I'm not sure if they show up-to-date info on their ETFs. Right now, it's just, the Yahoo is scraping Vanguard's info. So I'm not sure if they say, hey, this is what we have from Vanguard at the end of the quarter, at the end of the month. I don't know, but let's take a look. So we're going to go to Vanguard.com, personal investors, and we're going to type in VCIT. Vanguard Intermediate Corporate Bond ETF. There we go. Let's take a gander, shall we? Let's see what we got here. Expense ratio 5 basis points. Ooh, right now, there we go. Ooh, not even close to that. It's all right. Always go to the horse's mouth. 2.63. Yeesh. And that's as of the close of business on Friday. Woo! That's freaking ugly. All right, 2.63 is a 30-day SEC yield. And that's all you want. You don't care about the trailing 12 months, what's called TTM. Could care less. I want the 30-day SEC yield. The 30 days says, what has this paid over the last 30 days? The trailing 12 months, it just doesn't mean anything because we don't know what that will be going forward, simply because a lot of those bonds that were part of the yield of the trailing 12 months have matured and they're no longer in existence. So we want the 30-day SEC yield. So right now it's paying 2.63%. That's ugly. All right, so let's look at the portfolio. Let's see here. Does it tell us on here? I want to see. Oh, there, portfolio composition. Oh man, look at that. Yeesh. It's this is actually a little bit different than I had. Yep, 39.6 single A. 39.6. Single A. We got BAA. Let's see what BAA is. So they're using they're not using the Standard & Poor's. BAA, I think, is that Moody's? 53.4% in BAA. All right, so now the duration is 6.3 years. All right, so so you can see what happened just last month. The last month, the duration went up from 5.4 to 6.3. And the the yield went down to 2.63. All right, let's take a look at what BAA is. I know a BBB is the highest level or the lowest level of investment grade bonds. So what are BAA? I've never been able to remember the bonds. I just don't deal a lot with bonds, but I remember. All right, so let's see what BAA bonds. Let's see, what is BAA bonds? Not bah. It said, what's BAA? Bah, black sheep. It is Moody's, okay. So here's Moody's BAA bonds, corporate bond yield. All right. Let's take a look. I have a sneaky suspicion it's going to be the equivalent of triple Bs for S&P. All right, so BAA. Whoa! Okay, bonds rated below B. Okay, they're the same thing as triple Bs. BAA is the lowest level of investment grade bonds according to Moody's. Okay, there we go. So the credit rating system, AAA is the highest bond rating and indicates the safest bonds for investors. Bonds rated below BAA. Yeah, there you go. The lowest in investment grade. So the lowest investment grade. Eesh. So that means you're not scraping the barrel here, but man, are you getting rewarded much for that much risk? I mean, 53% is in BAA bonds. Now this duration of 6.3, that simply says if interest rates go up by 1%, the price of the bond will go down by 6.3%. All right, so if interest rates go up by 1, the price will go down by 6.3. Right now, this fund is trading at, what was it close at the other day? What was I going to say? 91.30. All right, so closed at 91.30. And so if interest rates went up by 1%, well, where's my trusty calculator? That fund would go down by 0.3 minus 6.3%. That'd go down to $85. All right, so that's not small potatoes there, man. And again, I'm not sure interest rates will go up by 1% anytime soon, but who knows? Now, if interest rates go up by 2%, all right, 2%, this will go down 12.6%. Oops. That's how duration works. So when duration is the way you factor in the price performance, giving a certain level increase in interest rates. So that's pretty ugly, man. I'm not going to lie to you. Let's see. So if you can find, let's see what Ginnie Mae is doing. Let's just go to Ginnie Mae, VF, because if you're only getting 2.63 on a pretty risky bond fund with a pretty significant duration of 6.3. And the average maturity on that fund is 7.8 years as well. If someone's saying they can give you 3 to 4 to 5% with no risk, I don't know where that could possibly be coming from. Especially if it's a liquid account, i.e., you can have access to your money. No way, man. All right, let's look at Ginnie Mae to give you an example. Man, I always get that in my eye. I gotta get one of those things that Dustin has over at Jazz Wealth, where he just has that electronic thing. And Dustin's a high roller. He is rolling in his sophistication. All I do is pick up dog poop in the back of my, being sent to my dungeon that doesn't have drywall, where you can see the studs. I'm like in low A baseball at the New York Penn League, and Dustin's released at Triple A. All right, so Ginnie Mae right now is paying 1.81. All right, so VFIIX 1.81%, and that's all AAA rated bonds. 91% U.S. government, 1.9% U.S. government, the safest you can get. Duration 1 year. Effective maturity 3. So we'll just say average maturity. So you can see the difference there. 1.81 in Ginnie Mae, which is a government guaranteed bond fund. 1 year is a duration, hardly any interest rate risk at all in that regard. Yield to maturity 1, very liquid, very safe. And so if this is the how can I say this? If that's what the bonds are doing now, and it's essentially the safest bonds that are out there, because if you look at let's look at Vanguard Treasuries. Let's say Vanguard Intermediate Treasury. Let's see. Do they even have one? Government. Maybe they call it government. Intermediate. Okay. Intermediate bond index, corporate bond, investment grade. They'll just look at the intermediate bond index just to get a gauge here what that's doing right now. And I bet the high yields are paying about 4.5, which is crazy to me. I would not touch that with a 10-foot pole. Yeah, so right now the intermediate bond index is paying 1.43. All right, so there you go. So I'm not gonna write that down. So Ginnie Mae is your safest fund that you can get with the highest yield. For nothing comes close. The intermediate bond index is paying 1.41, which is 42 basis points. I guess 40 basis points lower than this right here. And if that doesn't seem like a much difference, but if you take 0.4 divided by 1.81, you're sacrificing 22% yield for taking on more risk, because the intermediate bond index does have some corporates in there. And so the fund will have, they got 24% in BAA and 17.6 in single A and 53% in governments. I don't know why you'd buy this over Ginnie Mae. I don't get that. Let's look what the high yield is doing. I haven't looked at this in a long time. High yield right there. High yield corporate fund is paying let's see what we got here. 5.92. That's much higher than I would have thought. All right, so the high yield 5.92%. Okay, that's much higher than I would have thought. I would have thought about 4.5 to 5. Oh yeah, it was taking it on the chin. It fell from let's see, it's gone down quite a bit in price here in this year. Yeah, man. If you would invest at $10,000 10 years ago, it was worth 18,849 basically at the start of all this stuff at the end of February. Now it's down to it went down as low as 16,835. So it lost $2,000, man. It lost 2,000 on 18.8. That's 2 divided by 18.8. Yeah, it's down 10%. So the high yield fund's down 10%, which is why the yield is so much higher than it was. Before this all came out, the high yields were only yielding 4.5. It just goes to show you that's risky. And we talk about the credit quality. Yeah, they got 20% in BA3. So it goes down to, so you got BAA, BAA2, BAA3, BA1, BA3. So basically down to B2. It's, the credit quality is it's called junk bonds, below investment grade junk bonds. So essentially what's happening here is this. Let's see what the duration on this guy is. I bet it's low. Yeah, the duration is only 3. But average maturity is 5. So the duration is low, but the thing with junk bonds, and even with Ginnie Mae, the interest rate cycle isn't the biggest risk to junk bond fund. It's the ability for that company to stay solvent. Interest rate cycle isn't that big of a deal to Ginnie Mae because it's really mortgages, so it's a long-term proposition anyway. But be that as it may, a lot of people say, hey, what's my risk if the interest rates go up a full percentage point? There it is, it's low, but again, it's somewhat irrelevant relative to the stability of those bonds that are owned in that fund itself. I mean, if you want to take on the risk, that's fine. But you're taking 5.92 junk bonds. It's already down 10% this year. Well, at least from the last cycle there. I wouldn't touch that with a 10-foot pole, man. So anyway, the point was, if someone is saying you can get better than this in a short-term liquid account, I wonder how. If someone's saying you get between 4 and 6% interest with no risk, how? I mean, how are you doing that? Now, I will, in defense of the insurance companies, not just insurance companies, but a lot of these funds have, like Ginnie Mae and insurance companies, they're buying long-term bonds. All right, so they have a lot of 30-year bonds in there that they bought, 10, 15 years ago. But even 15 years ago, let's take a look. Treasury.gov. Even 15 years ago, the yields weren't very much. So let's take a look. So 15 years ago, in 2005. Let's see what we had in 2005. And I'll tell you what I'm talking about here right now. So the 30-year Treasury right now is at 1.4. All right. So insurance companies, what they do in pensions and insurance companies are the biggest player in the fixed income market by far. Pensions, insurance companies, and of course governments. So they're buying long-term bonds to still stabilize their portfolio of securities. That way, when someone dies, they have the resources in which to liquidate it to pay off the wife of me when I die from all the hard air I spew. All right, so in 2005, there wasn't any 30-year bonds. So they were paying, the 20-year is paying about 4.5. So let's even go back to 2002. When did they get rid of the 30-year bonds? Insurance companies like the safe long-term stuff, as do pensions, in order to, yeah, there you go. So in 2002, 30-year treasuries are paying 5.25. All right, so basically they're 5.5, 5.25. So back in, that's what, 20 years ago, they were paying 5.25. A lot of those bonds are maturing in 10 years, all right? So they're getting a higher yield on those long-term bonds, but those bonds are being matured all the time. I'm telling you, I bet the average maturity on a life insurance company is about 12 to 15 years. And so if the average maturity is 12 to 15 years, those bonds are coming due. And when they come due, they're being replaced not with 5.5, 5.25, they're being replaced with 1.4 to 1.5. So it's literally an impossibility for you to get 5.92 or 5 in this certain environment without taking risk with a liquid account. Unless you've already had that account for a long, long time, i.e. you've had your whole life insurance policy going back to 1992 or something like that. It's just not happening. If you're getting that kind of yield right here, you're getting it because of risk. There's no other way around that. There's no other way around that. You can't have both things. So just be advised. When you're hearing people, I can get, just be careful, man. I'm telling you, there's a risk out there. And for those who are ignorant about it, they can wake up like I did. And my man from Hartford in 2008 say, whoa, we didn't anticipate this. And that was bad. All right, I'd love to hear your thoughts. We'll see you.